ANZ Research now sees a later start to rate cuts in Australia, but sees a bigger rate cut in February in New Zealand. Donald Trump threatens to issue a big new tariff, and India's GDP was much weaker than expected, increasing the chances of a rate cut later this week. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's New Zealand chief economist Sharon Zollner explains why she sees just 75 basis points of rate cuts, rather than the 125 basis points the Reserve Bank of New Zealand sees.
There is a lot of uncertainty about how rapidly the economy will recover, but our gut feel is that by April next year, things will be looking quite a lot sunnier, and so perhaps the Reserve Bank will think that they've done enough.
But first, in 5 and 5 with ANZ, markets were mixed and quiet over the weekend, with the US markets becalmed during Thanksgiving. There was plenty of action in Australasia, though, on Friday, as ANZ Group Chief Economist Richard Yetzinger attests.
We brought forward some of the easing we expect from the RBNZ, so we now have them going 50 basis points at the next meeting, and we pushed back the easing we expect from the Reserve Bank of Australia to start the cycle in February, now pushing that back to May next year. I can't recall a time we've revised the RBA and the RBNZ on the same day, within an hour of each other or so, in fact, and in opposite directions. I'll use a phrase I used earlier for much of 2024. Mid-cycle slowdowns are interest rate purgatory. Local conditions matter enormously. Starting points matter enormously, and correlation across economies is quite low, and this latest revision highlights that very clearly.
Number 2, ANZ Research has changed its call for Australia's cash rate. It now sees the first cut in May next year rather than February, and only 2 cuts in the cycle rather than 3. Here's ANZ Head of Australian Economics, Adam Boyton, to explain.
There are a few differences between Australia and a number of other economies, and the first and the most important one to remember is, of course, the cash rate in Australia at 4.35 never got as high as it did in places like the United States, Canada, or New Zealand. But secondly, what we've seen over the past few months is signs of certainly stronger than expected employment growth. Employment growth has been stronger than expected. Business conditions remain around long-run average levels, and we're starting to see on the consumer side, consumer confidence picking up in the wake of the stage 3 tax cuts. Now, to be clear, you wouldn't say the Australian economy is strong, but it certainly has proven probably a bit more resilient to higher interest rates than we would have thought, say, 6 months ago.
Number 3, Australian private sector credit rose 0.6% in October, which was up from 0.5% in September, and the strongest result since June. It was driven by a 1% rise in lending to businesses, also the strongest since June. Here's ANZ Australia economist Maddie Dunk to explain.
If we look at things like the NAB business survey, for example, it's still showing that business conditions are really resilient. They're hovering around long-run average levels. Confidence has ticked up recently too, so that's up at its highest level in a few years. And there are signs businesses are feeling a bit better, and maybe the fact that we're past the worst point for the consumer is flowing through into how businesses feel about the outlook.
Number 4, India's GDP grew 5.4% in the September quarter from a year ago, which was substantially below the Reserve Bank of India's expectations and market forecasts. Here's ANZ economist in India, Dheeraj Nim, on why this cyclical slowdown makes a rate cut more likely later this week.
Even with a growth rebound, which is expected to happen in Q4, as some high-frequency indicators are telling, there is a considerable downside risk now to the Reserve Bank of India's growth outlook. We think that growth is likely to fall below 6.5% for the whole year FY25, that is the fiscal year ending March 2025. What it means for policy is that it requires a bit of rebalancing as far as policy focus is concerned, so that economic weakness could be arrested in the economy as early as possible. We expect that the Reserve Bank of India will start cutting the policy rate as early as in their meeting on 6 December 2024, while maintaining their stance as neutral.
Number 5, Donald Trump threatened on Saturday to impose 100% tariffs on countries such as Brazil, India, Russia, and China if they try to create a reserve currency alternative to the US dollar. That came after Trump threatened to impose 25% tariffs on Canada and Mexico, and another 10% on China. Speaking to Richard after the 25% threat, but before the 100% threat, he cautioned against jumping to conclusions.
Some of Trump's picks look very unconventional. Others look a little bit more within the bounds of conventionality. So I think trying to avoid rushing to judgment is useful, because the balance between those things will be really important. The second issue is the US economy. While the Fed is easing, the economy is pretty fully employed in the US. If Trump does put 25% tariffs on the US's three largest trading partners, that is going to be an inflationary problem for the US. And what that will do is shift the trade around, but won't really destroy the trade. The third issue is the timing here is going to be pretty important, because it seems like the rough plan is let's deregulate, debureaucratize, pump more oil to get energy prices down, and that will kind of free up the resources for us to be a bit less internationalist on the trade side. That's not going to happen in 3, 6 or 12 months. So I think we have some time to get used to what this new world order is likely to actually mean.
Richard Yetzinger there. Now for our deep dive interview, ANZ Chief Economist for New Zealand, Sharon Zollner, explains the change in call for the Reserve Bank of New Zealand's rate cut in February to 50 basis points from 25 basis points.
However, in communications thereafter, starting with the Governor at the press conference and following through over the next 24 hours from various senior members of the Reserve Bank Committee, it was very much the fact that they were saying that the default move would be 50 points that they expected, conditional on the data evolving as they expect, that the next move would be a 50-point cut, not a 25. When we look at our forecasts for the data that's coming out between now and then, that's GDP, CPI, unemployment are the big three, our forecasts are actually extremely similar to theirs. So when you've got everyone singing from the same hymn sheet and saying, well, 50 is the default, I think you need to have a pretty strong story to not expect a 50. And looking at our forecast, we don't have that. Of course, that doesn't mean that a 50 is a slam dunk. The data absolutely could surprise them, could surprise us, and we may well see things turn around and move back in the direction of a 25. But at the moment, a 50 basis point cut does seem likelier than not. However, when we look at the economy, we can see quite a vigorous response actually to the rate cuts that we've seen, which in one regard isn't surprising because the slowdown was deliberately caused by higher interest rates. So lower interest rates are an obvious cure, but they don't tend to be an instantaneous one. A lot of people are on fixed mortgage rates, so some sectors such as retail will have to wait before they see any relief. But in the most interest rate sensitive sectors such as construction, we're definitely seeing a lift there. We've also seen a strong lift across our business outlook and our consumer confidence surveys this week. So consumer confidence was out today, up 9 points. So that's probably a mix of lower interest rates and also lower inflation. We have definitely seen in the last few years that people just really despise inflation. It really upsets them even if the economy is strong. And of course, the economy's been anything but recently. But the consumer is feeling more positive. Yes, unemployment's still rising, but even there was some relative good news in that the Reserve Bank's now forecasting unemployment to peak at 5.2% rather than 5.4%. So if that comes to fruition, then I think it would certainly be fair to say that the human cost of getting inflation back down to target sustainably has been smaller than was originally envisaged. But of course, the unemployment does lag activity, so we're still very much in wait and see on that one. But we've still got the OCR falling to just 3.5%. So actually only 2 more cuts. If we have a 50 in February, that just leaves 25 to go. So we've got 25 in April, and then you'd have to sort of characterise that as a fairly abrupt stop. The Reserve Bank, for its part, sees a couple more cuts in there, taking the OCR down to 3%. But there is a lot of uncertainty about how low rates will go.
What's the reasoning for forecasting the official cash rate to only drop to 3.5% when the Reserve Bank is saying it's going to be more like 3%?
We're seeing some resilience across our business survey and our consumer survey, and not just wild optimism. I mean, to be fair, you can understand why business confidence is so high. The question is, are business conditions going to be better or worse a year from now? And things are pretty bad now and rates are coming down. So you'd have to be a real pessimist to not think that things are going to be better a year from now. But the better economic correlation is actually with the questions that we've added about asking how the last month has gone relative to a year earlier. And those move fairly closely with GDP. And we've seen a decent lift there, consistent with the Reserve Bank's and our expectation that GDP growth will resume in the last 3 months of this year, that this next number that's going to come out could be another small negative. But after that, things will start to look up. But there is a lot of uncertainty about how rapidly the economy will recover. But our gut feel is that by April next year, things will be looking quite a lot sunnier. And so perhaps the Reserve Bank will think that they've done enough.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, December the 2nd. Catch you tomorrow with more on the big numbers ahead this week, including Australian GDP on Wednesday and US jobs on Friday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.